Greetings, it is time for another CrashWatch video. And the nature of these videos is that we have chronicled the gradual decline in the S&P 500 that is entirely predictable from the Federal Reserve tightening monetary policy when they should not be tightening. Of course, they printed too much in the first place. They overdo it each time, as many videos on this channel explain. So let me hide my face. This is the S&P 500 as a 5-year chart. And as you can see, there was an original head and shoulders pattern as described in some of the earlier CrashWatch videos, and after that there was a further fall, and it's always one step forward, 2 steps down. So this is still an orderly decline that is not causing a lot of panic. Now, to the extent we believe that the Federal Reserve is actually managing the stock market, that's not a good thing, but they are cushioning the decline to make it be in a gradual sense. It has fallen from 4,800 plus to 3,752 and recently as low as sub 3,600. And I've long maintained that the ultimate low is in the low 3,000s, and that would be a pretty good entry point relative to this long-term trend line. So this is the S&P 500's 5-year chart. Now remember that when the Federal Reserve is tightening so excessively based on inflation that has already occurred, even though the internals of future inflation are weakening greatly, as I point out in many videos on this channel, they will overshoot again, and despite this orderly management, they can cause something to break. And to see how that breakage may unfold, we look at the 30-year Treasury Yield. We could look at the 10-year Treasury Yield as well. The 30-year Treasury Yield is very similar, so we go there. This is the yield of the US 30-year Treasury bond as issued. And this interest rate is really shooting up. There was some resistance over here in the low 3s, and now it has just shot straight up, and it is at 4.3%. 4.3%. From 3% to 4.3% very quickly, and this is higher than at any point in the prior 5 years. In fact, I could take even a 10 or 20-year chart, and you would see how high this actually is. This is a 10-year chart, so this yield on the 30-year bond is much higher than at any point in the last 10 years. The steepness of the gradient is the problem. This has a lot of ties to mortgage rates because most mortgages are also 30 years, and to tighten in this steep of a manner to cause yields to rise so quickly is what can cause a catastrophic breakage in the system and a much deeper stock market correction as well as economic recession that would not comprise a soft landing. Now, a recession like that will be very brief because they will simply resume their money printing again, but why do they have to overshoot in both directions again and again? Can't they do things closer to what I recommend on this channel, which are pretty obvious, and I'm not the only person recommending these solutions either. There is a path of moderation that they manage to not hit any of the times that they try to tighten and ease and tighten and ease. So with this being the 30-year bond yield, let's look at a very similar measurement, 30-year mortgage rates. This is the 30-year fixed mortgage rate in the United States, and as you can see, things were pretty stable for most of the last 10 years, 2012 all the way up to COVID, 2019, and then the amount of money printing that the Federal Reserve did, particularly in the form of buying mortgage-backed securities as well as treasuries, caused mortgage rates to be unusually low, and a lot of people who don't understand that buying a house is a two-variable equation overbought over here. They were happy to pay more for a house as long as the interest rate is low, not realizing they put themselves in a position of negative home equity versus making home equity. That is something I explain in a lot of detail in this video up here that you see in the upper right hand corner. But now that the Federal Reserve is over tightening because they overshot in the first place, this is the increase in the mortgage rate that we see. This is astronomically huge. There has never been an increase this steep. It is more than doubling. We had something in the 2.65 range, and now it is up to 6.94. In fact, it's almost a tripling. This greatly reduces home affordability and home prices. And ironically, the only thing that has delayed a big reckoning from happening so far is what the Federal Reserve is over-tightening in response to in the first place, which is inflation. They're so afraid of inflation, but they look at the rearview mirror, past inflation versus the internals of future inflation, that they overshoot their tightening. that inflation keeps nominal GDP higher so that millions of jobs are not lost because businesses act on nominal GDP. Sure, costs may have risen 6% while your income has only risen 4%, so you have a minus 2% decline, but at least you are not losing your job, in which case your income drops 100%. The Federal Reserve is trying to make the number of jobs go down so that housing affordability goes down, even though this is a problem they created in the first place. And a mortgage rate this high is very bearish for housing. This is the same type of negative pressure that caused the 2008-2009 housing bust, and in response they'll have to print money again. Of course, the same type of QE they did before, buying treasuries and mortgage-backed securities, won't work because that's what they've done for 12 years, and that is extremely saturated as a method. The only remaining method that all market forces are being pushed towards is to send cash directly to people, and eventually they're going to have to do that, but that was the answer 10 years ago as well. That's why they really cannot figure out what the right thing to do is, because these PhD economists are all hyper theoretical and they've all memorized the same textbooks that are about 70 years out of date. So this is bearish for the stock market, of course, but also for the housing market. So now we go back to the S&P 500. So that's why we see this decline in the S&P 500, but it has not yet reacted to that extremely steep rise in the mortgage rate that we just saw, because that causes homes to go into negative equity, and that has a major multiplier effect on consumer confidence in the United States. That's why I say the ultimate bottom is in the low 3,000s. It could very well go lower than that, but the low 3,000s is a good point of entry for anyone on the sidelines based on these long-term trends. Now remember, nothing that I say in these videos is investment advice. I'm just teaching you how to look up charts and how to judge what these charts imply and what the correlations between these charts are, but don't do any trade or not do any trade based on anything I say in these videos. These videos are designed to be useful even years after the fact because they are for educational purposes only. But this was the CrashWatch video for October 23rd, 2022. And if you find this type of content to be informative, I encourage you to subscribe to this channel and hit the notification bell. Thank you very much for watching.